Hello, my name is Kirsten Sunderman. The following presentation will cover performance analysis for NextGen Tech, a new company that entered into the undeveloped microcomputer market, spending the last 8 quarters creating and marketing laptops and desktops for business use. The market is composed of 5 customer segments: cost cutter, innovator, Mercedes, traveler, and workhorse. Using market research along with trial and error, NextGen Tech was able to capture a 41% majority market share of the overall industry, with particularly high performance in the Mercedes, innovator, and traveler segments. There are 3 main competitors in the industry: Microcomputing Global, Dell, and Cipher. We will begin with an industry analysis, considering the external forces surrounding the firm's activities. The global microcomputer market is broken into 6 geographical regions, each with their own economic circumstances. Prior to the launch of the microcomputing market, each region was responding to a global economic crisis. The North American region saw slow but steady growth over the course of the past 2 years. Prior to the first quarter of NextGen's business operations, the global recession had left the North American region struggling, with Canada and Mexico desperately hoping to find success on the coattails of the US, Japan, and Europe. United States interest rates were at a historical low at the beginning of the period, rising by a full point during the 5th quarter. The spike was justified by sustained economic growth, but the impact stifled purchasing power over the following quarters. Nearing the end of NextGen's second year in business, the region started to see some genuine upturn. GDP began to rise, unemployment rates lowered, and consumer confidence slowly grew. This gradual improvement offered reassurances, but came with lower price demands as buyers hesitated to make the most efficient use of their resources. The European region took a notable hit from the recession that preceded NextGen's infancy. With high unemployment and low interest rates, the region saw minimal growth in the first 2 quarters, as analysts worried about a growing trade deficit. Towards the end of the firm's first year in business, the region began to perk up, seeing upticks in foreign investment with pockets of encouragement, like Warsaw, who gained international capital and found the capacity to make infrastructure investments. Over the course of the following year, growth remained fairly stagnant as the region struggled to recover. While the technology sector demands grew, the need for continually lowered prices competed with rising inflation. Eastern Europe fared better overall compared to Western Europe and is expected to see a boom in technology in the coming quarters. As NextGen Tech launched their business, the Middle East struggled in the economic impact of the recession. Short-term gains were seemingly non-existent. Fortunately, as time passed, the region was able to recover, thanks to long-term investments and dependency on resources like crude oil to keep their export lines open. As NextGen entered their second year of business, the region began to experience relief and recovery, with the technology sector enjoying rapid growth. As demand increased sharply, buyers' bulk orders required lower prices. Looking forward, the region's economy is shaky at best, as the area continues to face new war threats and debt repayment concerns. Although demand continues to grow, businesses are unlikely to afford increased prices in computers. Africa was in a weak economic spot when NextGen Tech entered the technology sector. Following the recession, the region faced high unemployment, low household income, and inflation increases that only added to existing social and political problems. Some areas, like Ghana and South Africa, are hopeful as they work towards diplomatic solutions that can reinvigorate their markets. In NextGen's second year, both countries discovered new oil sources, drawing foreign investment, increasing industry, and the demand for technology. As the year drew to a close, the region saw hopeful improvements in their future, with global demand for their rich natural resources growing. Unlike other regions, Asia Pacific fared well coming out of the global recession preceding NextGen Tech's market entrance. China and India enjoyed a growing export market while consciously watching the North American region's recovery. Smaller countries like Japan faced greater struggle as their economies were linked integrally with North America. Overall, the region's exports depend highly on their cross-Pacific neighbors' economic stability for their own growth. Despite these uncertainties, China and India invested heavily in the electronics industry. Moving into NextGen's second year of business, the region saw Japan struggling to recover, overly dependent on a singular export market, while China and India entered new markets and enjoying an economic boom. Increased demand introduced a new challenge. Analysts worried about a supply shortage for electronic inventory. Fortunately, the concerns were short-lived and had only a temporary impact on increased prices for consumer and industrial goods. Looking ahead, the region is encouraged by the growth in their export counterparts and look forward to continued growth and economic success. In contrast to more developed regions, Latin America fared well through the recession that set the stage for next-gen tech emergence. Having previously recognized a need to expand their industry reliance beyond agriculture and tourism, the region was able to emerge from the crisis with notable resilience. Brazil fared especially well, leading the region economically. Looking to Asia, several Latin American countries expanded their international trade and enjoyed notable economic growth, especially Brazil, Chile, and the Dominican Republic. Countries throughout the region continue to diversify their economic platforms, taking advantage of a variety of natural resources. As trade improved, demand for microcomputers grew hand in hand. Prices are predicted to remain low from downward pressure. Porter's Five Forces analysis gives us an opportunity to review the challenges and opportunities that next-gen tech and the rest of the microcomputing industry was able to review as a whole. When next-gen tech launched alongside their competitors, they were all first movers in a new industry. Microcomputers were a novel introduction to consumers. The fresh new market offered an open field for innovation and market share, with a variety of customers up for grabs and no previously established players. A business-to-business marketing model offered reduced risk as firms were able to sell without the added cost layer of retail intermediaries. Additional costs were eliminated as buyers purchased in bulk for entire organizations rather than for individuals. The new market opened up at the close of an economic recession, allowing firms the opportunity to slowly test the market. However, entering the new market alongside several other competitors left a lot to the unknown. Supply chains and sales channels were uncharted. Competitor product offerings, prices, and sales strategies were unknown. As the microcomputer market was first being introduced, the global economy was on the tail end of a 2-year-long recession, with several of the market's ideal sales markets suffering from high unemployment and buyer uncertainty. This extenuated already hesitant markets like the Mercedes buyers, who prefer to see products succeed before investing. Over the course of the first 2 years of operation, the firm faces a recovery economy that trades increasing demand with increasing pressure for lower prices. The market relies on supplies primarily from the Asia-Pacific region, which fared well through the economic crisis, placing power in the hands of suppliers who can justify higher prices and control inventory supply. This makes markets like cost cutters difficult to profit from, since the demand for lower prices is so essential. The nature of the product stretches the cycle of repeat customers, since they must make a substantial investment and will not require new replacements for some time. Sales teams must constantly be hunting for new relationships.
Hello, my name is Mary Ballard, and I am here to discuss the company analysis. Starting with the company resources, on the human resources side, we have 236 salespeople split between our sales offices and our web center, slightly favoring our sales offices. For the sales office personnel, they average selling 56.6 units per person, and then on the web center side, it's 124.4 per person. We also have 990 production workers that are working at 100% productivity. For physical resources, we have a production facility in Sao Paulo that is currently at 94% utilization. We also have 10 sales offices and 5 web centers that are covering every region of the world. For the organizational resources, we have a cohesive executive team that makes a lot of decisions together, as well as strong brand management and a strong advertising campaign. Moving into the value chain, looking at the activities, we have heavy investments in increasing quality and reducing changeover costs for production. We also have 62% of our sales from the web center, so that is the strongest area for our distribution. And we have robust and successful advertising campaigns as part of the marketing. In the support area, we have heavy investments in research and development innovations so that we can create the brands that make the most sense for the customer segments we are targeting. We also have the best employee compensation package in the industry, along with training and special incentives for our sales teams. And that leads into the sustained competitive advantage that we have over our competitors. One is our well known, reliable, high quality brands due to the strong brand judgment, strong ad copy judgment, and the investments in quality and reliability, as well as the innovation focused strategy. So that's one that's not particularly easy to copy, as it requires a lot of investment, and particularly investing smartly in which R&D items are the most important for the customers we're targeting. And that covers the company analysis.
Hi, I'm Nana Adamako, and I'll be presenting our competitive strategy and our performance analysis. Our competitive strategy was a focused differentiation strategy targeting the Mercedes segment in locations which can absorb high prices. In locations such as Chicago in North America and LA in North America. We differentiated on high pricing power and high profit margin potential. We didn't always take advantage of the profit margin potential. However, we always had high pricing power. We would have taken advantage of a high pricing power in the subsequent quarters if the simulation continued. We feel our strategy is very appropriate for the industry because we exhibited extreme success from the beginning to the end. In the test market, we started out with a 41% total market share and 100% of the Mercedes segment. In the 8th quarter, we ended with 41% total market share and 85% of the Mercedes segment. We feel the data exhibits that our strategy is very successful and helped us succeed, help us win the simulation. Now to the performance analysis. I'll start out by talking about the trends. The data showed a parabolic divergence in demand from the industry, which led to exceptional inventory turnover and revenue recognition throughout the simulation. And with successful cost management, it led to us recording an outstanding amount of net income into our retained earnings. So let me restate that. We had high demand, which led to generating a lot of revenue, which, because we could manage our cost, led to higher than normal net income. Now let's move on to the ratios. As I previously stated, we managed our debt very well. So the statistics show that from the prior 4 quarters, we actually had exceptional debt management. We had the best debt ratios for the previous 4 quarters. And we consistently outperformed in the turnover ratios, leading to the highest total asset turnover in the last year. Furthermore, we diligently worked, which is exhibited by us outperforming the industry lows from Q4 to Q8. Every single statistic beat the industry lows from Q4 to Q8. Now, we feel that our strategy, which was again a focused differentiation strategy and differentiating on high profit margin and high pricing power, led to this extreme success that we had. And if the simulation continued, we feel that we would have been able to continue this level of success.
Hello, I'm John Cadell, and I'll be discussing our proposed strategy for the upcoming quarters 8 through 12. We will have no significant change in our strategy from the previous quarters, the strategy we developed in the beginning. Our target segment is Mercedes and always has been. What we will have is a slight shift back from a deviation that occurred in quarters 6 through 7. During that time, we didn't have sufficient product for Mercedes, so what we did was we targeted workhorse product just to fill idle capacity and generate some additional revenue that could be thrown back into research and development to get us to our final target. In quarter 12, that workhorse product will be discontinued in favor of the more favorable Mercedes target or demand. Our competitive strategy has always been a focused differentiation strategy targeting Mercedes. That's something that's worked really well for us in quarters 1 through 8, as we have captured majority of the market share, even in segments that we weren't pursuing at the time. So that will serve us well with the Mercedes segment going forward. Human resources is an aspect that we will continue to look into as our functional strategy. Our sales force target will be close to 400 personnel by quarter 12. This will be split among local and regional web offices. The compensation packages for these will be increased until we can get to a 95% plus productivity level. The health benefits in this sector are already maxed out, so it'll be a mix of salary and pension increases until we can reach that target. Our sales office are brand ambassadors, and as such, we want to make sure that they meet the similar high performance and quality product that we are actually producing. Our production workforce is already meeting 100% productivity, so what we'll do in that segment is we'll continue to monitor industry trends and competitor compensation packages to ensure that we are providing the top level of pay and compensation for our employees to ensure that we are having and creating the best products with the best people. As such, as if anything does drop that, we will adjust accordingly to ensure that we reach that 100% level. Our production operations, we will increase our fixed capacity by 100 to 200 units per day per quarter through quarter 12. That fixed capacity will be increased in proportion to the demand that we project for the Mercedes segment. Our assumption is that with new research and development technologies to incorporate into our products, we will have an increased demand for that through better products. The Workhorse product will be discontinued after quarter 12 because we will shift our focus back to the Mercedes segment and use that fixed capacity to produce our primary segment. We will have 6 products being produced up until quarter 12, which is at the point where we drop the Workhorse products. Another aspect is our quality improvement. We will continue and invest heavily in that to ensure that we have the reputation of the most reliable and highest performing products on the market. Research and development is an area that we will continue to invest heavily on. It's something that has worked well for us. It's something that's really needed to ensure that we can capture the Mercedes target segment. We will be investing $6 to $9 million per quarter until quarter 12, and that will increase in the future, really to ensure that we guarantee ourselves as the leader in the industry for this technology, for this market segment. Marketing is another aspect that we will continue to invest in also. We will not be opening any new sales office or a web sales center. Through previous decisions, we have positioned ourselves across the globe in our regional centers, our web sales, and all of our local sales offices are located in the cities with the highest demand for the Mercedes target segment, which is our primary market segment. We will increase our budgeting increase our budget in marketing, and that's to ensure that our advertisements continue to be the best in the industry. And our assumption there is an increased marketing budget will lead to increased demand in our target segment. That is our proposed strategy. Thank you for listening.